So in order to better address regulatory issues in the market, the Federal Reserve recently implemented risk retention requirements that CMBS lenders are going to hold on to somewhere in the top 5% of the offering on their books. I think that there's been already, and that's happening, I believe, at the end of this year, if I'm not mistaken.
It is. I think it's November.
November,
Yeah,
okay.
November 30th, I think, to be.
So, but I mean, already even in, I mean, we're in April, but even, I was hearing talk about this in January, February, March as
Sure.
well, and how that put a major slowdown on the CMBS market. Seems like I was just talking to some folks from Barclays Capital and some of the other CMBS shops out there recently and this morning, and it seems like things have picked up a little bit again. But I think that trickles down a little bit to you guys as well, and to really everybody, the banks, life companies, everybody. How has it impacted you? What do you see? I mean, is it more cash, is it more, deal flow to you guys? Is it, you know, what other ways do you feel like it?
Certainly, we view it as a positive for our type of product. Again, we're bridge lenders, we're 3-1-1 type of terms. So generally, we're going to get properties that are in transition. However, there may be situations where a property is coming off a CMBS loan, needs to be refinanced, and naturally may have gone into another CMBS loan. But because of the turbulence in the market with CMBS, we'll get a look at deals like that now. And we're already seeing that. We're already seeing deals that are coming off of CMBS that can't go back to CMBS. Some because the individual property may have issues itself, maybe it lost some leases.
Sure.
But the borrower may be more concerned about pricing too.
Got it.
What's happening a lot is a borrower that's doing CMBS will sign a term sheet at a certain spread, and a couple days before closing, that spread is no longer what they signed up.
Got it.
So borrowers are mindful of that, and I think it gives us, guys like us, an opportunity to do business with someone who may have more naturally gone to CMBS, and someone who may feel like, I don't want to lock in right now, where I feel my property still has some migration upwards in cash flow, and I might take a short-term deal because of the dislocation in CMBS. As well, I'll take a short-term deal and I'll lock in 2 to 3 years from now once things have settled down.
Interesting. Now, I don't know, do these new CMBS the risk retention regulations, does it also hit you on your portfolio? Because are you guys holding your loans on your balance sheet, or are you selling them in a pool as well?
So we put our loans in a CLO.
Okay.
And then we do retain our risk pieces. So we would meet
and
that.
you already do it?
We already do it. We've always done it.
You've always done it. Got it. Okay.
We've been in the CLO market for the last 3 years.
Got it.
As I said, we've always maintained our risk pieces.
And CLO is commercial loan obligation, is that correct?
Yeah.
For offering?
It's collateral loan obligation.
Collateral loan obligation. Okay, great.
It's effectively a securitization vehicle.
But you've held it the whole time, so it doesn't really affect you guys. It doesn't change what you've been doing the whole time.
Exactly.
Okay, that's interesting. Great.
Yeah.
Wonderful. Well, Eric, thanks very much for joining us. Really appreciate it. That was very interesting. It's Andrew Benioff and Eric Baum for the Lenrock blog. Thanks for joining us today.
Thank you.